Hi, everybody. Sorry to interrupt your lunch, especially that of Gary, who is, well, I'll give a couple of minutes to eat. Thanks very much for coming. There was a fierce note on the invitation that some of you observed about how it's going to start dead on 12:15, so I'm already a few minutes late. But I think we've got a ton of interesting stuff to hear, and maybe this is one of those topics that I think a number of us feel we want to know about. We may have thought for a while we didn't need to know about it, but now we realize, as Gary has said and the others, the authors, about it is really time to take this business seriously, a decade into Bitcoin. And we have fantastic speakers here today to help us to learn. I was also just noting to Simon that the timing, I think, is really good, in part because who would have predicted it, but it is today that the FT has an op-ed, an editorial about it's time for cryptocurrencies to come in from the shadows or something like that. And that's triggered by the interest of a number of commercial banks in joining on. So this is a very relevant topic for all of us. So I will just tell you, give a brief note on the speakers and the run of show. Both Simon Johnson and Gary Gensler I have had the luck to be colleagues with both of them, one in the IMF, Simon, and one in the US Treasury, Gary. But I'm to introduce them today as Simon is the Ronald A. Kurtz Professor of Entrepreneurship at the MIT Sloan School of Management, where, of course, he's head of global economics and management. And he's also been a senior fellow here since 2008. And he worked on this digital currency initiative, is working on that at MIT's Media Lab, and supervising the research projects related to blockchain. When I knew him, he was worrying about the global economy at the IMF. Gary Gensler is a senior advisor to Simon at the MIT Media Lab and to the initiative, the Digital Currency Initiative, and the Ethics and Governance of AI project, as well as a senior lecturer at the School of Management. And of course, Gary served as chairman of the CFTC for 5 years, more than the first big chunk of the Obama administration. And he's currently chairman of the Maryland Financial Consumer Protection Commission. So he comes at this from all sides. Gary is going to give the presentation, then Gary and Simon will both be ready to answer questions, and then Martin Chortzemscher, who is a research fellow here, has worked as a Fulbright scholar in Germany, where he got this is interesting, expertise in financial innovation. So it's interesting to think about getting that in Germany. I think many of us in the US are a bit snarky about how that's something you need to learn in the US or maybe even the UK. He has also done research in Beijing and has a master's in public administration and development from Harvard Kennedy School of Government. He's writing about Chinese financial technology in a book that's coming out soon. So all of them span the economics, regulatory, and fintech world. So we can all plan to end up a lot smarter at the end of this presentation. And now over to Gary, please. Thank you.
Caroline, thank you for that kind introduction. Thank you for that kind introduction. And the Peterson Institute, thank you for hosting this talk today. Before I get going, I apologize in advance. I'm currently teaching a blockchain and money course at MIT, and they mic me up and I walk around. So if I walk away from this, I apologize. But secondly, I apologize because I'm so used to the 90 or so students that are in that class who are full of energy, and of course they're at MIT, so they're bright as can be. And so I will be a little bit, some of these slides that I'll be using talk about the Geneva Report, but they do go beyond the Geneva report in a couple places around central bank digital currency and some things that we thought, Simon and I thought would be of interest here. Could I start before we dig into this just to ask, I want to get a sense of the room. How many people in the room have owned a cryptocurrency, a Bitcoin or Ether or anything like that, just to see if there's, okay, so we have two. We have the photographer and Martin. Sorry, self-disclosed. I asked that question in a congressional hearing in July, and I did get it pre-approved by the chairman of the House Agriculture Committee. But as a witness, I asked the committee, and one of the members of the committee raised his hand, so I'm wondering what his local press did after that. I think he's actually the chairman of the House Judiciary Committee. So, so I'm gonna walk us through a little bit of this presentation, and if you have any questions in the middle of it, don't hesitate if I've glossed over something or gotten too technical. This is really meant to be an economic talk, not a technical talk, but I will hit upon some tech. So let's see if this all works. So there's an individual or individuals named Satoshi Nakamoto who wrote a paper in the midst of the financial crisis. So I start on Halloween night, October 31st, 2008, with Satoshi Nakamoto. And we truly don't actually know who this individual is, who wrote a simple paper with this little thought. I've been working on a new electronic cash system that's fully peer-to-peer with no trusted third party. If you take nothing else away from this talk, you can go back to Satoshi Nakamoto's Halloween paper, and this is how, if I might say, he or she started the paper. We actually don't know who this individual is. But it was trying to solve a riddle that had existed from the 1990s when the internet started and there was peer-to-peer communication without a centralized authority. Packets of information move around the internet today. Most of us in this room don't know how it really works, nor do we really know how the carburetor works in our car. This was a riddle, how to move value around the internet without central authorities like packets of information. It was not solved in the 1990s. There was 15 or 20 efforts to try to solve it with cryptography and so forth. But in 2008, Satoshi Nakamoto wrote this paper and put it out on a email list, which was actually called a cypherpunk email list. It was an old cryptography email list, and all of a sudden we had a paper but nothing else. So the question was, will this build upon the internet? The internet's layers of the Ethernet that communicates between two computers, the internet, which is TCP/IP, which is communicating amongst numerous computers rather than just two computers, HTTP, which is really the World Wide Web, how to browse on the internet, and very importantly, in 1996 was a protocol layer about security. Again, we don't need to go through that here, but there's several important key layers of the internet, and the question really was, in this paper, might Bitcoin or something like Bitcoin be another layer on the internet to peer-to-peer move value on the internet with no central authority? All four of these other layers and the many sub-layers have no central authority. One government could say, I want to shut down the internet, but it still goes. It still exists. There's no central internet authority like we have central banks. So what is a blockchain? This will be the only technical slide. But first, it's a time-stamped append-only log. These were around from the early 1990s. Two gentlemen working at Bell Labs actually came up with the concept of time stamping and appending a log, adding blocks of data. Blockchain is just blocks of data added over and over again. The longest running blockchain actually appears in the New York Times weekly, and it's been running since 1995. Stuart Haber, was one of those Bell Labs scientists, and he thought you could actually digitally, cryptographically timestamp documents in a timestamp log, and he prints in the New York Times weekly, and it's still running, a cryptographic hash function weekly in the classifieds. And it's the longest running timestamp log, and Satoshi Nakamoto actually cites Haber's work in the early 90s in his paper. I'm just putting it and grounding it in history, and it sort of demystifies it. And Haber's been running, it was a company called Surety. It didn't take off, but it's still running. It was a modest startup. The next thing really is it creates an auditable database. So there is really a database, and databases are at the core and the center of all of finance, because what is finance yet? But finance for thousands of years has been about ledgers. In fact, written languages probably started in written numbers, and words came second, because for commerce, we really had to embed it in ledgers and money. So it's a database, but in this case, the database, again, it's my only technical slide. It's secured via cryptography. Cryptography, what is cryptography? It's really basically a way to ensure and commit to communication in the face of adversaries. I mean, the Romans and Greeks had to use cryptography at war. Many of us have watched the imitation games and seen how Turing helped break the enigma machine of the German government. They didn't give due credit, by the way, to the Polish who had broken it earlier in the movie. But cryptography now in the face of the internet caused all sorts of new challenges. And that layer from 1996 was a layer that had cryptography, but here it's a database with cryptography without getting into the details. But the third piece is some consensus protocol. You've probably heard something about Bitcoin mining or Bitcoin consensus. It's all the question of who gets to add the next block of data. That's all it is. It's really, but if there's no central authority, who gets to add the next block of data? And in Bitcoin, it uses a consensus protocol called proof of work, and we can talk about Byzantine generals problems, which is a mathematical problem that was highlighted by 3 or 4 computer scientists in the 1980s. It doesn't really go back to Byzantine time, but they used, I mean, I guess the Byzantine generals wouldn't be offended by the paper. It was politically okay. That's it for technology. That's it. So blockchain technology basically verifiably moves data on a decentralized network. That's the key to it. Data being moved on a decentralized network. And yes, the data can also be computational code. In 2013, 4 years after Bitcoin came about, a 19-year-old from Canada, Vitalik Buterin, who was writing for a Bitcoin magazine, said, you know, you don't just need to move data, we could do computational code. And Vitalik went on to found, with a venture capitalist from Canada, Joe Lubin, something called the Ethereum network. So it can be data. Vitalik's now 24. But you can move data, or you can actually use computational code. So thus, this goes straight to the plumbing of finance. I've been around finance my whole life at Goldman Sachs and in public service. I mean, finance is about moving value, which is data, and risk, which you can think of as computational code or an algorithm, around a distributed network, 7 billion people. So it goes to the central plumbing of finance, and Simon and I and our co-authors thought it could be a catalyst for change in this sector. But broad adoption really will not happen and can't happen, in our view, until technical, commercial, and public policy hurdles are addressed. So first, in finance, a couple of the opportunities that we see. Centralized intermediaries concentrate risk, and they also have a lot of economic rents. Central bank legacy payment systems give some opportunity for this technology, particularly in, believe it or not, legacy countries like the US that have not updated our technologies in the payment world. We are doing that, but we haven't done much. Clearing and settlement, There's also, of course, finance has a lot of crises. This room has studied these crises, and fiat currencies have instabilities. For those who think that Bitcoin is a currency, those three classic roles of a currency, of a store of value, a medium of exchange, and a unit of account, though it doesn't fulfill all of those fully, I think our paper would say it could. And in some instances, it is a store of value, even though it's a very highly volatile store of value. In some instances, it's a medium of exchange, but usually in the dark markets and drug markets and illicit markets, but it still is a medium of exchange, even if most of society might not like that. And it's only really a unit account in the crypto economics world, not so much in the day-to-day commercial worlds. And so one area that it might be able to dig into is the financial sector is about a $1.5 trillion sector in the U.S., or 7.5% of the economy. So does that give some opportunity to move in and come under some of the economic rents in the system? However, the financial sector says blockchain technology has its problems as well, and there's a bunch of them. Performance, scalability, privacy, security. We won't dig into that. Our paper does. We kind of believe that over time, whether it's 3 years or 13 years, that a lot of the performance and scalability and even the privacy and security issues will be conquerable. There's a real potential. The tougher issues, frankly, are interoperability and governance. Governance being, if you have an immutable ledger and an immutable technology, how do you do software updates? How do you push out software updates and actually change something? Bitcoin's monetary policy is set all the way out to 2140. What if it actually got adopted? Maybe the government of Venezuela or the people of Venezuela say Bitcoin's better than their currency. I mean, don't compete it with euros or dollars, but maybe in Venezuela. But then the monetary policy is set till 2140. How do you change it if there's some reason to change it? So interoperability and governance are tougher, longer-term issues in our thought process. Commercial use cases, there's no market-wide commercial use case. Probably the biggest use case is crypto, finance, speculation, basically. Another big commercial use case is illicit activity, dark markets. But there's some smaller commercial use cases that are completely legal. None of them use more than about 1,500 users a day. I mean, the data is watched and so forth, so it's not big, broad commercial use. CryptoKitties is one of them. Some of them are gambling sites, legal gambling sites. Some of them are gaming sites, and so forth. And then there's a public policy challenges. So basically, financial sector largely favors today permission systems. Permission systems are closed. They're building on the timestamp logs. They're building on the cryptography. Wall Street, finance around the globe says that's good, but we don't really need this open ledger that everybody can amend, the permissionless blockchains of Bitcoin. And so most of the development, 90+% of the development's on the left-hand side. The Australian Stock Exchange is changing their legacy, clearing and settling using a permission blockchain. IBM has the biggest software development in the permission space called Hyperledger. There's Corda and so forth. That's where a lot of the development is, but I wouldn't count out the right-hand side, the permissionless, and that's what we're trying to lay out in the paper. The use cases, I won't go through these, they're in the paper, but here are 6 or 7 or 8 of the areas. None are enterprise-wise at this point in time. I see somebody taking pictures of this. We permission, the Peterson Institute can send the slides to you if you want, so feel free to ask Carolyn for them later. And then in terms of what's going on, 3 quick things I'm going to hit. Initial coin offerings, you may have heard, is a new form of crowdfunding that's going on. Token economics, people might call it. There's been 4,000 plus offerings put up on websites. Not all of them have raised money, but nearly 3,000 have raised money, and over half of them have already failed, and it's only about a year and a half in. Many of them are scams and frauds, but some of them might take off. The largest offerings have been over $4 billion. There's several that have been $1 billion plus offerings. So they're starting to compete. You're seeing Jay Clayton in the Securities and Exchange Commission saying, when is this a securities offering, when is it not? And it's a very interesting area of the law and an interesting area of finance around token economics. One might think back to the private banknote days as well, that you're sort of having private banknotes for file sharing or file storage or private bank. I see Marty Grunberg from the FDIC. You probably know more about private banknotes and the history of banking than I do, but it's another form of, in essence, private banknotes, you might think. This is the market, $220 billion strong, highly volatile. It peaked at about $800 billion in January. It's been settled around 200 to 300 billion. A little over half is Bitcoin, 55% or so in that slide. But Ethereum is quite big. A currency called Ripple that you might hear in the banking sector is probably third, if I remember, on the charts. But it gives you a sense of the volatility. There's a lot of investors in this space, but it's small. The worldwide equity markets are 80 to 90 trillion. The worldwide bond markets are 250 trillion. That's partly why Mark Carney and the Financial Stability Board has said this is probably not a systemic issue yet, but it's definitely worth a lot of monitoring. Incumbents are eyeing crypto finance, like this lioness on the corner there, but they like the volatility. Incumbents like volatility, can make money off of volatility. They also like the biggest exchange, Coinbase, has 20 million customers, which competes with the size of Fidelity. Coinbase is doing a venture capital raise at an $8 billion valuation. So these are not small companies any longer. Some of them are what's called unicorns in the fintech space, billion-dollar capitalizations or more. In fact, many of them are. And so the startups also have a little bit ability to beg for forgiveness. I'm sorry to say this with such an esteemed regulator, but incumbents need to ask for permission, and startups tend to break a bunch of china and then get hauled into the regulators, and then there's some regulatory forbearance to get them into compliance. They usually don't go to jail. Sometimes they do. But very interestingly, the owner of the New York Stock Exchange, Intercontinental Exchange, is starting up something in November that's a very interesting project about Bitcoin payments and Bitcoin futures that we could get into in the questions. Public policy frameworks matter. There's three. I've talked at a lot, and Simon's talked a lot of conferences around the globe, but I put them in three buckets. Illicit activity. There's really, amongst the 180 countries, probably 160 agree. Some don't, usually very small population centers like Malta and Liechtenstein and stuff. It's similar to what happens in tax havens. When you have small population and you can grab somebody's other economics, you don't mind shrinking the other country's tax bases. But largely, there's conformity. Most people want to break the back of illicit activity in the crypto space, but the implementation is spotty, and it's tough implementation. We talked about financial stability, and then investor protection. I'd say investor protection's all over the lot. The SEC here and the Canadians are kind of leaning in about these initial coin offerings, which represent about a quarter of the $200 billion market. But many other nations are saying, let 1,000 flowers bloom. This is a new form of crowdfunding. We should not regulate it except by consumer protection laws, but no investor protections. And so that is a wide open, almost Wild West, which I highlight on this slide, but I'm going to skip through. And then I share with you a bunch of the individual policy issues. One that is particularly joined in Europe is GDPR and privacy. The blockchain is not fully private. You can actually see what's called public addresses or Bitcoin addresses if you're in Bitcoin. It's how the FBI tracked some of the Russian involvement in the 2016 election, that they could actually follow the pseudonymous addresses. They're not fully anonymous. So now there's a new law in Europe the privacy directive. And a lot of financial firms are saying the blockchain is too public because it's a public ledger, how to deal with that. And so it's an interesting set of policy issues that we don't have yet in the US, but it's real. Crypto exchanges are another area that are a place that you could engage as public policy. It's a gateway. There's over 30 million members, but they lack any oversight. There's about 200 exchanges right now, and they're a mess. That's a technical term. But there's really no oversight in terms of manipulation. The Japanese are probably furthest ahead trying to make sure that they comply with what we here in the U.S. would call Bank Secrecy Act laws. But in the U.S., they're still registered as state money transmitters. I believe that we need to do something if this ever grows bigger. We need a national regime, and the Department of Treasury and Financial Crimes Enforcement should be involved rather than being treated like MoneyGram or at 50 or so different states. I run this little commission in Maryland, and only one exchange is registered in Maryland. And we know more than one is doing business with the 6 million people that live in Maryland. But there's not a lot of staff to go chase them from the state of Maryland. So it seems to a problem that needs to be solved. Central bank digital currencies, and then I'll close out. It's kind of a fun topic. First, I would say central banks already issued digital currencies. It's called bank reserves. Money is already electronic, and the 9,000 or so commercial banks in the U.S. have a digital currency with the central bank. So that's already happening, and now the private sector is starting to do something called stable value coins. One's called Tether, which is the biggest, has some questions about it, but there are others, basically a cryptocurrency that's pegged to a fiat currency. So the private sector is nudging up. The central official sector already has digital currency, though it's wholesale, and it's a closed loop with the banking system. I see Marty smiling and wondering if I'm right here. So the real strategic question for central banks is whether to open up their ledger, open up their digital reserves, be expanded. The country that's furthest along on it's really Sweden with their e-krona project. But here are the design considerations. How widely do we make it accessible? Is it just wholesale? In essence, central bank digital currencies are wholesale right now. 9,000 U.S. banks tie into it. But do you open it up to merchants? Do you open it up to the retail public? These are some of the debates going on in Sweden right now. Is it a token or account-based? Literally, do you have an electronic token, or do you keep it on the ledgers of the central bank or commercial banks? Is it interest-bearing or not? Does it have other services? Most would say that the more you make it like a bank deposit, the more you'll disintermediate the commercial banking sector. And thus, the concerns are real. In a run, it's going to undermine the whole system because people would run to the central bank digital currency away from commercial banks. Obviously, it will change some of the commercial bank deposits and funding models and affect credit allocation, monetary policy, resilience of the payment system, and can we guard against illicit activity? However, believe it or not, there are countries very serious about this, and Sweden leaning forward. It might happen in countries that are destabilized, too. I don't know. Our thinking is probably we'll see something here. There's 180 countries, so we shouldn't think that somebody won't do it in the next 5 or 10 years. So that's it. I think I'm supposed to hand it over, but basically the peer-to-peer networks is the central innovation of Satoshi Nakamoto, augmented by Buteran's computational code. We think it is probably going to be a catalyst for change, but there's a lot of hurdles, and to get there, it's got to address those hurdles. So I don't know if I hand it to you, Carolyn, or Martin, or Simon.
Thanks very much indeed. So I think I, at any rate, know a bit more. Seemed Marty maybe knew it all already. I'm going to turn it over to Martin, and then my understanding was that Simon, you were going to answer questions, but maybe you have a presentation as well. Okay, so let's have Martin, and then we'll go.
a PowerPoint that should come up. Thank you for having me here. I actually had my first Bitcoin sent to me at the MIT Media Lab, so thank you for that. Thanks to it, I was able to ride this massive boom in crypto finance in a microcosm. My $5 of 0.0001 Bitcoin turned into about $35 at the peak, so I wasn't quite rich, but I got to ride that a little bit. I'm gonna focus mostly on the paper in this, and then give some of my own thoughts, and focusing on the impact of blockchain on finance. So the authors essentially argue that there are enormous benefits and that our existing public policy frameworks are essentially up to the task in managing them to a great extent. The last portion on the regulatory side is very much they need to be brought into our existing frameworks. The channels of the benefits are improving automation. This is mostly the side of existing institutions doing what they already do, but a little bit cheaper and maybe more effectively, more transparently, thanks to blockchain technology. But that also, and more speculatively, there could be new business models that are decentralized that can potentially replace these institutions that are currently very powerful. However, there are lots of challenges that he mentioned that block adoption. One of the biggest here is that we have a chicken and egg problem. The fact that there are such large network effects in creating a decentralized system mean that it's not very valuable if you're the first person to use it, but they're not very scalable. So it's very hard to reach that kind of critical mass where the thing actually works and is valuable. They say the path to incremental adoption is not clear. There are many promising experiments that they point out, but none of them quite work yet. And they say the US law is essentially the law, at least in the case of the securities area. If you're launching an initial coin offering in another country, if you sell to any American investor ever, you are supposed to hire a bunch of American lawyers, determine if it's a security or a commodity, go through all that process. I think their framework is extremely useful in terms of whether or not a blockchain solution is the right solution for a given application. They follow COAS, looking at transactions costs and whether or not it makes sense to do it in a firm or in a centralized way versus in a market or a decentralized way using a blockchain. So here on the bottom, I have my own graphical representation of their framework. On the left side is decentralized systems. There, as you know, there are less risks of the capture, less risks of rents, less single points of failure and concentration of risks, whereas centralized systems have more costs in that area. And then here on the trade-off, which is usually not discussed very much when people talk about blockchain, is the fact that a decentralized system is usually a mess. It's usually extremely difficult to coordinate. That leads to coordination costs. Everyone has probably heard about the fact that Bitcoin's network uses more electricity than many countries, and that is a measure that's costly, but it gives the network security, and it's also very difficult to scale, partially because of these issues. And you'll notice that those two lines intersect more towards the centralized side, and I think that's the reason why, as Gary said, most of the applications so far have been focused on permissioned blockchains that are more centralized but allow maybe a little bit more degree of decentralization than would have done otherwise. I do have some unanswered questions that were brought up by reading this paper. The first is using this framework and applying it to the actual applications. In the paper, the applications are discussed with a little bit of detail, giving a sense of what they are, but the framework isn't applied there. And that would help us, if it were applied, get more of a sense of what exactly are the costs of trust. How would you quantify the costs of trust? How would you quantify the coordination costs and compare how they would apply differently to different applications? And the second is looking at all these barriers from technical to business and governance. Which of these are more likely to be resolved in the short, medium, and long term? Some of these I think are probably intractable. Some of them are quite solvable with a little bit better technology, say the scaling issue. And this would give us some idea, how these barriers apply to different applications connected with when they're likely to be resolved would give us an idea of where the impact on finance is likely to be seen. I'll end with some of my own observations on the potential impact of blockchain on finance. I actually believe that the greatest potential is not in all this back office stuff. It's not in the same institutions doing what they've always been doing with a little bit better technical systems that allow them to save some money. That's definitely not worth all the ink that's been spilled and all the time that's been spent discussing blockchain technology. What's really going to be interesting is, does it allow new ways of governing organizations, decentralized organizations that are worldwide that use very different frameworks? And that depends on them actually being governed well themselves. I think these other issues of scalability and privacy and security can be overcome if the project is well governed. One example is early in Bitcoin's history, there was an error in the code which would allow you to spend someone else's Bitcoin. And the whole point of Bitcoin is that you can't spend someone else's Bitcoin. This would have destroyed the network. But luckily enough for them, the person who found it out had invested a lot of money in Bitcoin mining equipment that would have been useless if the market, if Bitcoin went to zero. Therefore, he reported it to 2 people who then updated the software, and they managed to cross that. But that's not a decentralized model of governance. That is an extremely centralized model with a couple people that make the decisions. It's not functionally, and the issue is that that kind of model doesn't scale. Once Bitcoin becomes bigger, once there are more participants in the network, more types of participants in the network, it gets harder to coordinate them. So if you consider now how Bitcoin has dealt with the scalability issues, it's been a complete mess. They have, some groups have split off and created their own version of the blockchain, and it seems to be impossible to coordinate them. So they'll have to deal with these issues well to be able to have these new decentralized organizations that could be much more impactful. And another side is, we talk a little bit about smart contracts and automation, but the fact is that code has a hard time interacting with the real world. The real world is messy. The real world doesn't have discrete 1 and 0 outcomes, and you're going to need a whole set of governance outside the blockchain to be able to handle these. So if you think about Bitcoin, for example, it does a really good job of sending the value without a trusted intermediary. However, there's usually something else on the other side of that transaction. You're receiving some value, receiving a service, and you have to trust the other counterparty to do that. The technical system doesn't fully solve these problems. And so far, the intermediaries in the blockchain space make Lehman look quite good. If you had invested your money in Bitcoin early on, I think everyone I know who's invested in Bitcoin has lost a lot of it, either from their wallet account being hacked or their exchange being hacked. And so although you might think they're rich now because they bought at 1 and now it's at whatever, 5,000, a lot of those have disappeared due to those issues of intermediaries. However, I think there's a lot of reason for optimism that it will have a large impact on finance, and this is because of 2 great trends. One is the fact that people are living more of their lives online, that more economic value is created online, and that will allow these systems to be more self-contained, not just payments, but also the other side of it, all together in one separate economy that doesn't necessarily need to touch any of the offline financial systems that we deal with. And that's going to create enormous potential for it to have more impact. And the second is in the interaction with the real world, that Internet of Things sensors being attached to more things in the real world will allow the code to automatically take into account what's happening on the ground, say a shipment of goods from one country to another that gets scanned, or doesn't even need to get scanned. It has a GPS system, it knows where it is, and then can be automated, and that will help. So I will end with that.
Thank you very much. So we will now come up onto the stage, and I give Simon maybe first, and then Gary a chance to respond to Martin, and then we'll open it up for questions. So Simon, go ahead.
Thanks very much, Caroline. Thank you to the Peterson Institute and to Adam Posen and colleagues for giving us this opportunity to present the report. And I should also say thank you to Charles Viplosh, who has been the mastermind behind these Geneva reports for many, many years. And I think, Charles has developed an enviable reputation for spotting topics and issues before the benefit from further analysis and study. And he asked us to take this this report on with Michael Casey, Jonah Crane, and Neha Narula. It's been really a team effort. We've got people on our team who know a lot about computer science. That's Neha. People who are very deeply in the private sector and following those activities, such as Michael, and Jonah Crane, who's a leading expert on financial regulation, and Gary, you just heard from. I think so. And thanks for the comments, Martin. And by the way, this is an extremely fun and very fast-changing and sometimes confusing area. We have a seminar discussion group every Tuesday evening at MIT, and you're all welcome to come and hang out with us and listen to the people coming in with their new business ideas. I mean, frankly, they don't make a lot of sense many days, but neither did some of the people in the 1990s who were pitching us on internet-related ideas, and you know where that ended up. Martin, I think, was used to come to our seminars, even though he was studying at another institution, the name of which I forget. But he can certainly attest that it's a free-for-all, it's open to everyone, and it's a very real invitation. And actually, a surprising number of people take me up on this and do show up on Tuesdays at MIT. I think that the crypto, to the sort of point of our paper and the general and the title, I think that the development of Bitcoin, Ethereum, and related technologies has already been a catalyst. I think it's really shaken people in the financial sector in good, healthy ways, thinking about competition, thinking about new ways of organizing things. Why is our data organized in this way? It's just some horrible legacy system. Let's modernize it. I do think Martin puts his finger on the key point, and hopefully this also comes through the report, but Martin was admirably succinct, which is, to what extent is this a tweaking of a rearrangement of clearing and settlement and some other, rearranging the deck chairs on whatever ocean liner you think we're on, which is, some billions of dollars of improved value perhaps, and maybe some reductions in financial risk, that would be nice, along the way. Or is it, and I think this is what draws Gary and me and our colleagues to this topic, is it the potential for a more profound change in who's in charge and how financial flows happen? And I think, Martin, to your very good point about governance, which is absolutely spot on, I don't think you end up with a completely decentralized, let's call it anarchic world. That doesn't seem to fit our experience. And the people who were early adopters of Bitcoin are very focused on the ways in which government can take your money from you. Well, they can, and they do around the world. But it turns out that lots of private people who are not associated with the government will also take your money from you, right? That was the point about the thefts of Bitcoin. So I think, though, what it does is it changes what Michael Casey likes to call the trust perimeter, or who are the trusted intermediaries? What does it mean to be an intermediary? I hope, and this is something that we talk about a lot in our group, that we move towards, as we rearrange more fundamentally the structure, we get a better structure with better consumer protection, more market integrity, less systemic risk. I think that's really important. And there are a lot of policy choices to be made, some of which are pretty obvious to you. Hopefully, more of them we lay out in the report, along with a pretty extensive set of recommendations. We wrote the report, we presented the report in May, and produced the paper version as quickly as possible, aware that it would go out of date. I think it's held up pretty well through September, but read it quickly before we're overtaken by events. It's clearly changing very, very fast. But the message for this town, certainly the message I'm giving the report in London tomorrow, same thing for them, which is think about the regulation, be deliberate about it. Sure, encourage innovation, absolutely. That's a big part of what we do at MIT. But try to guide it in a sensible way, I think fitting with the kinds of principles everyone in this room would agree with. And you will get a stronger sector, more jobs, better finance for your own country and globally. And let's have a bit of competition, maybe the US and London and other places, maybe in Singapore, for example, maybe China, although obviously they're pursuing a different path, but competing to provide a better, stronger financial model and a model for how you run payments and related forms of finance. That seems to be extremely healthy. So I would argue that the catalytic effect is already in place.
Okay, thanks. Gary, did you want to add anything to the response to Martin before we...
I just maybe a couple points. One is Martin's review with the slides. He was kind enough to give us credit, but actually, Martin, I'm asking permission whether I can use that with my students, because the graph with the two was a terrific, and I say it kiddingly, but I am going to use it with my students, because I think visually it does better than what we even wrote in words about the centralized to decentralized. I mean, economics for centuries, thousands of years, has tended towards some form of centralization. Why did people come from the village into the center square to form markets to sell their produce, their apples, or their barley? Because you could have central price discovery and central markets, more buyers and sellers coming together. So there is something around finance in particular that tends to centralization, and we have financial centers like London and New York, for instance. But on the other hand, as Martin's slide showed, and we write, I think there's trade-offs of concentrated risk, of economic rents, of also resiliency, that sometimes centralization then leads to instability, as we saw in the 2008 crisis. But it's not that decentralization is the answer to all of that, because it too comes with a significant number of coordination and governance issues. And I share the view that governance is a key challenge for the broader adoption. And it might be a challenge that's only partially addressed. And thus, the blockchain technology underlying Bitcoin might be adapted and adopted in some sectors and not in other sectors. So that's it. I do want to say something about all the lost Bitcoins. It's really stolen Bitcoins. The Wall Street Journal has done a sort of a survey. I think there's been reported about $2 billion of hacks or stolen currency. I figure if it's $2 billion reported, it's got to be more than that, because a lot of the crypto exchanges are not reporting it, so it could be 5 billion, 10 billion, and so forth. But it was only the photographer Martin that ever owned Bitcoin. But one of the ironies of this whole thing is that for the cryptography to work, you need to have what's called a private key. Think of it as your password to get your currency. Or think of it as your password to move some smart contract to implement some smart code. But if you lose that password, which is called a private key, there's no back door. One of the incredible features of blockchain is immutable, unamendable, but if you lose your password, what is more technically called a private key, you can't reproduce it. And so that's an interesting trade-off, because most of public policy, whether the legal system, the banking system, does involve some form of backdoors. The court system, we know, can adjudicate claims, or the banking sector sometimes can right some wrongs, or even the sector gives you a new password when we prove that we are who we are. So it's sort of an interesting, smaller but critical point about custody. And most human beings, I know I lose my password all the time. So what's happened is most people have centralized this stuff and said, could you please hold my private key for me? And so there's a lot of centralization around custody that's going on because of that issue.
Thanks very much. So I'm going to assert my privilege as chair to kick off the questioning, but I'm sure there are many questions that others will have. And one of the things that I think we should take advantage of was Gary's offer at the beginning of his presentation, which was, ask me questions if it doesn't. I don't think we should be worried about appearing ignorant in this on this topic, because I think there are a lot more questions and perhaps a lot less analytical thought that has gone on amongst some of us, at any rate, than in many of the other topics that we discuss. So I have just a larger and a smaller question. So one was around, it seems ironic to me that in a way what is happening right now is that big banks, big financial institutions are getting into blockchain, as we saw in the reports yesterday and today, and that in a way is pulling in regulators. And they're doing that because of concern about competition. And the competition is coming, of course, from very high-tech, big tech. And so do we think that there will be these inventors and with much more computing power and really pushing the technology that will in the end create products that get sucked into the existing financial system? So that's really about how much change will you get in the core of the finance. And I guess my other question is linked to that, which is you talked a lot about the economic rents, and it's certainly true that payments has a lot of that, and that with cross-border payments being often a rip-off and so on. But if I think about systemic risk, it's really more about the risk part of it and how risk is bundled and what does risk, what involves risk, which is often to do with leverage. So how does that part of when we think about regulation play into this new technology? So maybe I'll throw that to you, Gary. That was about, is this just a new way for banks to take over an invention from the tech people, or will the tech people manage to create a new governance structure? And then what are we thinking about risk and leverage?
All right, so do you want me to take the tech one and you'll take the risk one, Simon?
Whatever you want.
All right. I think it's worthwhile to ground it in a broader sense of finance and technology that really goes back literally thousands of years, and it's only just accelerated in the last 40 or 50 years. But as I said in my opening remarks, it's thought that even written words came after written numbers thousands of years ago. And what is a number system but a technology, literally, to record a ledger? And so when the telegraph came along in the 1840s, it started to change finance in small but discernible ways. Or there were debates in the 1920s whether the telephone would be allowed on the floor of the New York Stock Exchange or not. It was, but it took a couple of years of debate, and entrenched folks were fighting against that technology, literally fighting against it. And certainly when I was at the CFTC, I saw the debates, and they're still going on, about high-frequency trading and how one uses technology to intermediate and make markets. So I'd ground it in a long history, and I'd also say that blockchain is just one of 5 or 7 key technologies transforming finance right now. Artificial intelligence / machine learning. I mean, machine learning is sort of a little dumber than artificial intelligence, but put them less scary. It's fancy, advanced, and very advanced regression analysis. So AI, machine learning, blockchain, of course, but the cloud. We've now all are living with the cloud, but that's highly transformative in terms of the financial sector. Robotic processing automation, which literally has computers doing what you and I would do normally when we do data input or data entry and so forth like that. Tremendous change in mobile telephony and how mobile phones are being used and so forth. And I could go on with 3 or 4 other things, but the world of fintech is probably, the investment in fintech might be 4 or 5 times the investment in blockchain. So blockchain is a very serious part, but I would put it in that broader context. And to your question more specifically, I would think of it as the disruptors, the startups, the venture capitalists, the folks that are usually called fintech, but the disruptors. I think of big finance, the incumbents, and then big tech. And Apple already has Apple Pay. Well, my God, even Starbucks has a Starbucks wallet. And Starbucks is teaming up with Intercontinental Exchange on this new Bitcoin payment mechanism. And Microsoft is teaming up with ICE as well. Microsoft, because they're one of the 3 or 4 biggest providers of the cloud. Starbucks, because they're trying to disintermediate the 2.5% to 3% that most merchants in the U.S. pay to Visa and First Data for data processing. So the incumbent tech, big tech, wants in. There was rumors, maybe not true, that Facebook was looking to buy Coinbase, which is that largest exchange in the crypto space. So I think it's all this disruptors, big tech, and big finance, and J.P. Morgan or Goldman Sachs already spends multiple billions a year on technology. They're not run quite like big tech. The C-suite doesn't have a bunch of technologists, but they are in essence tech companies. Risk.
Well, first of all, how many people have a Starbucks card? You just don't adopt technology in this room. I can see that. I think that the big tech taking over, moving to finance is absolutely the topic, and this is one way to do it. Exactly, this ICE-Starbucks partnership is the most interesting thing to follow this year. I'm waiting anxiously to read Martin's book, because China is in the lead in terms of tech moving into finance, with all of the implications that brings. Of course, you're right to ask the question, Caroline, what does this do for risk? What does it do for systemic risk? Are we just creating a new version of credit default swaps where we thought it was a reasonable risk mitigation tool? It turns out to have, under some circumstances that matter, some pretty undesirable consequences. You know, I think honestly, we have to keep working on this, and there are, you know, fortunately, many people in top central banks who are thinking quite hard about this. The promise is that you could get more visibility into transactions and into market positions and into who owes what to whom. And maybe even, here's a radical thought, the people who run big banks could actually know
What's going on?
She said it, not me. Yes, more accurately, what the positions are of their bank, because literally they have trouble managing the data and the information within the bank. So are we going to get a change in how information is shared, and with whom and when? And does that help the regulators? Does that help the markets see where the systemic risk is, and does that reduce risk? I don't know, but it's absolutely very important open question. It's clearly not the case, and we said this, and Martin said this, that we're moving from a world with intermediaries that can fail to a world that's somehow much better because there are no intermediaries, so there's nothing to fail. Clearly not. You're changing the nature of intermediation, and you're changing where that risk is going to be parked, but clearly you can have failures, you can have crashes, you can have crises in the new world too.
I just say that probably the largest, financially, the largest example of the two questions Carolyn mentioned is in China, where the world's largest money market fund today, which is just about $300 billion in value, is run by Ant Financial. That sounds like a financial firm, but actually Ant Financial was created because the Chinese government told Alibaba, which is really an online merchant, you know, a mixture of Amazon, eBay, and other, that their digital payment mechanism, their wallet, which had grown so big, had to be more regulated like a financial firm. But it started out of, basically, if you thought of roughly Amazon providing a payment wallet, and then it grew so big that it literally had $300 billion of value in it. And they're doing wealth management. They're advising people on wealth management. So that's probably, and that's the intersection, and the Bank of China certainly had a point of view on it, of risk and big tech, in that case, taking over a large part of the financial sector. But then being defined as they are the financial sector then.
Mm-hmm. Thanks very much. So let me open it up to questions. Who would like to put a question from the floor or make a point? Which is fine. Yes, come to the mic, and then if you could introduce yourself.
Hi, John Kitchen. I'm with the CBO. As I hear this, and I will admit I don't fully understand the blockchain technology, but it seems like there's a potential for a systemic risk reduction element of it, in the sense of, if you think back of the financial crisis, there was a lot of just unknown exposure that financial institutions had when they were thinking about the MBSs and the different slices and derivative securities, and you didn't know the extent to which any institution might be exposed to different pieces of that, and that was a big part of the liquidity challenges that existed in terms of who you trusted or not. And it would seem like this type of technology then could play a role in helping to provide that kind of information, reducing risk, and the systemic aspect of in the financial system could be, systemic risk could be affected by that as well.
I concur that it's a technology that could lower systemic risk, but it could also raise systemic risk. I don't think it's just one directional. It's a database technology in a form to keep ledgers, so thus the more transparency about those ledgers, particularly using new cryptographic methods, something called zero-knowledge proofs that one of our colleagues, Neha Narul, has written an excellent paper on. Could give the official sector a window into what's happening and still maintain privacy. So it's an interesting opportunity, and I agree with you on that. Secondly, it could lower risk because it could sort of further rationalize, and one might even say clean up the back office. Less counterparty risk could be adopted. On the other hand, if it's an immutable ledger technology, crises usually have benefited, not always, but usually benefit by some human involvement. And if you have a hard-coded system on autopilot, in essence, and you can't shake it from that, as Chairman Grimberg would tell us, you know, there was some improvisation in the middle of the financial crisis that we, the public, all benefited from. So I just think that I agree with you. I think it could be risk reduction in multiple ways, but there's also some challenges when you make things immutable and not subject to human input in the moment of crisis.
Yeah, thanks. Martin, do you have anything to add on that? Because you came at it from more the question of governance, which I think goes more to the human intervention.
Sure. I think in this area, a lot of it is not actually going to need a blockchain as long as you have, a central party like the Fed that is, say, overseeing it. Really where the blockchain helps you is to be able to very quickly discover where there's a discrepancy in the records, where JP Morgan thinks it owns X and Chase thinks it owns Y. Well, I guess they're the same thing, but maybe even they don't even know in their own systems who owns what. So it would help them, it would help with that, but then if there's some issue within the contract and you don't know if it cleared, that part is not necessarily going to get solved. So I'm a bit skeptical about the use of blockchain technology there. Where I think the real benefit is in lighting the fire under them to say, let's actually get together and do this thing that we've been delaying for so long, which is having a really good technical monitoring system, and that they can attract really smart people from MIT to go work on it who otherwise would have no interest in working on in the back office in a bank on some of these systems, and that they actually get it done, because when they get it done and they say blockchain, the New York Times picks up their PR piece, and usually it wouldn't. So it gives them good incentives there to change.
Long Island Tea Company, blockchain tea company. Can you just introduce yourself?
Sunil Sharma from the George Washington University. When you think of technological change over the last few decades, what we've been seeing is that, in some sense, there's been an erosion of the franchise value of banks. Now, what's made banks special is that they are the closest to the payment system, right? We're thinking of, in some ways, fundamentally transforming the payment system. So imagine a world in which the payment system is separated from the bank as an asset manager, right? Would that be such a bad idea? Would that be transforming the system in a certain way that there would be less or more systemic risk? I mean, we're concerned about banks because the banks are special because they're close to the payment system. And if the payment system gets disrupted, then the real economy comes to a standstill in some ways. But if the way we are trying to rejigger the system, or the way the structural transformation is proceeding, it's not unreasonable to try and think about separating the payment system from the banks as asset managers. Maybe that would reduce systemic risk.
There's no question you could do that, and you could unbundle payments. You can have narrow banks. I think the worry is what happens to credit, right? So the banks have this function in the payment system. There's other ways to arrange that. How are you going to arrange credit? Who's going to make credit decisions and on what basis? So again, looking at Martin and to Gary's earlier point, Alipay, that's not a bank. right? I think maybe there's a bank legally behind. They own a bank, right? But it's not. It's not
told to own a bank.
right. It's not at its core, and it's not coming from legacy banking. And they are making credit decisions. Now, depending on how you think about that, perhaps that's an alternative way to arrange your financial system.
Yeah, and you already have it with or without blockchain. You have the initiatives of open banking in Europe, and its sort of sister in the UK. So I think we are starting to see this, where banks open up their interface, what's called an API, and allow merchants to access to the banking system. As I noted in the slide about central bank digital currency, we already have digital currency. It's called reserves. So how far does it go? I mean, modern banking's been around for 300 or 400 years. It's usually, in most cycles, served the economies well, and then sometimes it doesn't. I think we could definitely have payment systems unbundled, but then there's other economic and public policy issues, as I think Simon said, around the allocation of credit and who does that. But peer-to-peer lending is modest, but it is growing as well.
Hi, thanks. Sherry Stevenson, ICTSD, Geneva. My question is pretty simple, but I'd like an answer nonetheless. Since blockchain at present doesn't fulfill the functions that a currency does, a normal currency does, so it doesn't have a store of value and other things, what would it take for it to get there at any point? And is that just not an invisible future? Is that not in the cards?
Money for thousands of years has been a social consensus or social construct. And even from the days when it was cowrie shells in West Africa or tally sticks in the United Kingdom, or I'm not sure if you would all be familiar with it, there was an island in the South Pacific called Yap that had these big, heavy stones called rye stones that were quarried on an island a couple 100 kilometers away that served a form of money. So money is but a social construct. We chose over the last couple 100 years to put it in first paper form and then digital form, and we call it backed by our government, but it's still just a social construct. So I'm one to believe that Bitcoin can meet that social construct of, it is a store of value, a highly volatile store of value, but it is a store of value even now. It's a means of a medium of exchange, but most people wouldn't use it. But there are companies that are paying their lawyers in Bitcoin. Many, Perkins Coie and Cooley and Skadden Arps, if they have a blockchain initial coin offering company, some of the law firms will take payment in Bitcoin or Ether and so forth. They quickly sell it, but so it is some employees are paid in it as well. And probably once ICE, Intercontinental Exchange, and Starbucks does what they're going to do, probably somewhere in 2019, you'll be able to use Bitcoin at Starbucks, is my understanding and projection. To answer your question, though, it needs wide adoption. It doesn't have wide adoption. And fiat currency has numerous advantages. I'll just mention two. We as society, through our laws, say that it's accepted a form of for all debts, public and private. We call that legal tender. And two, our government and all governments around the globe accept fiat currency for the payment of taxes, which is anywhere from a quarter to a half of the economy. So fiat currency has two big advantages before you get to its stability through central banking that these new cryptos don't have. So
I would recommend watching the various so-called stablecoin developments and technologies. Again, these are moving quite fast. You'll see more announcements in the coming months, where people are trying to tie some cryptographic unit to the dollar. And as far as you, the consumer, are concerned, you may not know you're using Bitcoin in Starbucks. You may think you're using dollars. It looks like dollars. You have a dollar value. You don't care what's on the back end. If that back end has been transferred, you're no longer paying the credit card fees. Well, there's some value there for the people who arrange that. But you as a customer it may feel like the dollar interface is just the same, actually.
Sherman Robinson. Your point about fiat currency, one additional point. Legal tender means it must be accepted for all debts, public and private, and a dollar bill is a claim against commodities in the U.S. or anything else. None of these others have that have that property. None of them.
I'm agreeing with that.
Joachim Levy at the World Bank. My question is really more on the technical. I know there is only one slide technical, but you mentioned a very important thing, which is what makes a Bitcoin different from all the other electronic things that we have already, and the cards and so on, is the fact that it's not centralized. But then it goes to the heart of the problem, which is if it's not centralized, to get the trust, you have a very complicated mechanism, which is the proof of work. And this is basically insurmountable problem now. And the alternatives, including proof of stake and things like this, have big, wide doors for all sorts of fraud, etc. So when you look at that, do you see the technology really allowing the scaling up of this, or you get all the benefits of electronics, but not necessarily through a Bitcoin and decentralized approach?
What Martin is raising is a very central question. If Satoshi Nakamoto's innovation had three big parts: the use of timestamp logs, cryptography to basically validate and commit the ledger, and thirdly, this consensus mechanism. Permissioned closed-loop systems do the first two. There's a lot of benefits, and there's already been a catalyst for change. Timestamp logs, cryptography, committing to the ledger. But you're right, the decentralization only comes if you can solve this consensus, which right now is this proof of work. I do think it's slow, it's cumbersome, it's complex, and it takes a lot of electricity. But I believe whether it's 3 years or 13 years, there's either alternative consensus mechanisms, like you said, proof of stake is another one, or delegated Byzantine fault tolerance is yet another, and so forth. Some randomized way to pick who adds and appends the log. Or through, I'll get a little technical, through side chains. In essence, you have the protocol, which is the first chain, and then you do some netting elsewhere in what's called a side chain or a layer 2 or sharding. I think that will come along, the scalability. I think the governance issues that Martin raised are tougher issues long term, but you might be right. It might be that the scalability, Visa has to do about 100,000 transactions a second. DTCC, the New York Stock Exchange, and all the exchanges, coincidentally, the SEC wants them to be able to handle 100,000 transactions a second. Bitcoin is handling 3 to 10 transactions a second. It's a big scalability issue.
I want to just add one thing there, is that people generally don't recognize just how cryptography underlies all of our financial transactions today. The fact that crypto could be every dollar you transact. When cryptography secures your online banking app, cryptography secures how you know you're actually at the website you think you're at through certificates, so you're not downloading man-in-the-middle attacks. It's everywhere. So every dollar, you could say, is already a crypto dollar, and what's fundamentally makes it different is that they use that to manage the issuance of money and the seigniorage, how it gets allocated. And that the way you identify yourself is also with cryptography, but that crypto is already everywhere in the existing financial system.
Yeah, Joaquin, you had a response, and then.
Yeah, just completely. Yeah, I agree with the crypto. Everything that you do has some key and etc. And for the two other functions, as you may know, we at the bank, you have just issued a bond using blockchain. So that part, I think, works very well. It's a smaller part because it's just the ledger and custody, but that I have no doubt that is very effective and is a big leap in relation to what you have today. Thank you.
Excuse me, sir, but we can, yeah.
Hi, Susan Lund, McKinsey Global Institute. I'd be interested in hearing the applications for blockchain or Bitcoin that you think we're going to see move the furthest along in the next, say, 3 to 5 years. So I know we talked about the Starbucks Bitcoin ICE card. Other applications, is it in equities trading, OTC, fixed income trading? Is it in remittances, supply chain?
And can I add to that, how much of your view on and your answer depends on where there are kind of uncompeted away profit sources, patents right now?
Okay, so read the paper. It's all in here. But to highlight two, Susan, I think supply chains. There's a lot of, and I'm reacting also to people who come talk to us about technology, the kinds of projects that our students work on, the kind of companies our students set up and other people set up. So supply chain, there's a great deal of interest. There's a lot of legacy systems there. There's a big digitization agenda, and having some form of blockchain in that, I think, is companies, big players, and startups are finding to be very helpful. I think the second one I would flag is what Martin mentioned, which is the Internet of Things. So it's quite the opposite. It's not a legacy system. It's a brand new system. It's a huge amount of data. It's a vast number of devices. I think 7 billion devices currently, going up to something like 70 billion quite soon. Managing the data, managing the kinds of communication, the way in which they can communicate, and the way in which you can use the decentralized code or computational code feature. That is extremely interesting. And we had a speaker last night at MIT with a company in this space. Again, I don't know which companies win, which specific configuration of technology wins, but that does seem to be an extremely fruitful space.
And I would say I would not think it's going to be at the heart and the center of like equity markets or trading, because most markets benefit from centralization, like an equity market. And I think where it will be applied is where latency doesn't matter. The early places, it'll be hard for blockchain to compete if you need to do it in nanoseconds. No, maybe 20 and 30 years from now, I don't know, but not now. So it's probably where supply chain, Internet of Things, or even in finance, something like trade finance, or places which are not particularly centralized, do not currently have a central clearinghouse, and they're highly, if not paper, they're still email-based and so forth. Those, they may not be hot topics, but those will be areas that people can try out things that have lower latency and don't currently have a centralization. On Caroline's point, though, if there's a lot of economic rents, it's like a honeypot, and entrepreneurs will come trying to get part of the honey. So.
Hi, thank you. My name is Paul Marion. I'm a reporter and co-founder with MLEX US Tax Watch, which is a new tax publication owned by LexisNexis. And I noticed on the list of participants that next to the Peterson Institute, the single largest group of people here is from the Treasury Department. So for their benefit and mine, could you talk about the challenges and opportunities of cryptocurrencies and Bitcoin, or excuse me, blockchain for the IRS?
For the IRS. So I think that I'll start with the challenge of cryptocurrencies and then the opportunities. The challenge is that crimes and criminals don't go away. They just sort of adopt and adapt new technologies. And so there's a lot of illicit activity that, part of the history of this came from libertarian movements, and then also there was a feeling that we couldn't really trust central authorities, but it was also tied to a lot of illicit activity. Now, the U.S. Department of Treasury, the U.S. Justice Department, the FBI have done a number of large reported cases to take down dark markets, dark markets where you're selling illicit drugs, which is not just a Bitcoin challenge. It's also something that the U.S. government had to deal with, which is a network called Tor, T-O-R, which is basically you can anonymously go out on the network through that, which, by the way, our government promoted so that activists in countries, dissidents, could speak and get access to the internet. So I think that's a real challenge. I think particularly more challenging than Bitcoin are what's called privacy coins, and there's 4 or 5 of them. because as I mentioned, Bitcoin, you can follow the public addresses, and there's Bitcoin and blockchain forensics companies, and the Department of Treasury will be wise to work with them and the IRS to work with the forensics companies. I think that the challenge is going to be the privacy coins, Monero, Zcash, Dash, and the like. Those of you from the Treasury Department here know all these coins because they're really, have figured out how to be even more private. They use technologies called tumblers and other zero-knowledge proofs again. I think the other challenge for the U.S. Department of Treasury is that the crypto exchanges aren't reporting the gains and losses of their customers. So Coinbase, with 20 million customers, doesn't have a bunch of brokers sending out what's called 1099-Bs. So, wow. So you're a well-meaning U.S. citizen who happen to buy and sell Bitcoin. You really do believe that you're paying your taxes, but you never got one of those documents. Your tax attorney says, you know, can you send me all your 1099s? You don't even have a 1099-B. Even a well-meaning citizen could inadvertently not pay their taxes. And that doesn't even speak to all the people that don't want to pay their taxes. So I would encourage the IRS to write a rule that says crypto exchanges have to send out 1099s. That would be like a check-the-box thing. And oh, by the way, I'd have them say that foreign accounts have to be included in foreign bank account reports, or FBARs. But I think the IRS is probably wise enough to do that without me nudging them at this public session here.
So you're supposed to report capital gains on your Bitcoin appreciation.
Yeah, yes, you were supposed to, but even well-meaning citizens who don't get a 1099 might forget to, and then those who would say, well, they didn't send me anything, why would I care? And then when the IRS has to challenge the exchanges to get the information, and the IRS went into court against Coinbase. Now, they settled at a court. They got, like, I don't know, 10,000 of their accounts, not 20 million, but they got, at the time, there were 13 million accounts, and Coinbase didn't want to give up the information. So.
Yeah, we had some people on this table.
Thank you. My name is Diogo Coelho. I'm from the Brazilian Embassy. I found the presentation really interesting, and I noticed how decentralization is always a key feature of blockchains. But it's still not very clear to me on what degree it operates on a national basis. I mean, fiat money, the dollars, is very associated with, of course, not only the United States government, but its society as well. But are blockchain systems that are being developed in the US the same, similar, or communicating with those being developed in China? Because for me, from my understanding, Bitcoin doesn't have the same national ground that fiat money today has. So does any discussion on regulation would require some sort of international discussion on regulation? Can you say that Bitcoin is an international currency in its core? So what degree does it operate on a national basis or on an international basis? Thank you.
Thank you. And I'd like Martin, as well as Gary or Simon, to
Yeah, I think this is a huge challenge because you can launch an initial coin offering without registering a legal entity anywhere in the world, and it can be a team of people all throughout, marketed just over the internet with no even offices. So the big question is, does anybody have jurisdiction? And if one of them is a US investor, then the US would say, yes, we have jurisdiction. But if everyone has jurisdiction, then you'd have to comply with every country's local rules. That seems like too much to deal with. So maybe there could be something like what has been developed in the United States for some of the fintech companies, where previously you had to go state by state and get approval, and now they try to harmonize. So if you get approval with one, it's easier to get approval with the others. That's one potential way forward, but I just don't see any way that that governments can fully grasp whether it's exchanges or any of the launchers of these ICOs.
You're right. There's no geographic boundaries. It's truly a worldwide market for pretty much all of them, but Bitcoin and Ethereum for sure. The largest Bitcoin miners are in China and Russia. There's some thought that they may be even illicit within their own countries, but in some illicit arrangements with local authorities paying off to get cheap electricity and things like that. Might be. I'm not speaking with any authority, but there's questions about that. So it's truly an international. Around illicit activity, there's more consensus. The OECD, the Financial Stability Board, others, law enforcement and crime agencies are coordinating across countries. At MIT, we actually have been asked to speak in Japan and in Europe and a number of conferences and advise some government actors around the globe. I'd say the least amount of coordination right now is in the security space, where there really is quite a variety of societal and legal norms with regard to it.
Just one wrinkle on that. If you mine or verify transactions on the Bitcoin network, for example, you use a lot of electricity. We already discussed that. This is not, the power company knows where you are, and governments potentially and presumably know where you are. Now, relationships with governments at the local, state level obviously is complicated. It's not as private and as separate from government and intergovernmental relations as you might think. So, we think the right message for governments is create a better regulatory environment so that part of these crypto networks that affects your country runs better, generates more economic value, is more consistent with stability. Other governments may have other views, and that's something to think about as well, this sort of national security angle.
Bring it inside the public policy envelope, turn the dials of public policy. Maybe the SEC and others here will turn the dials a little bit, but bring it inside, and there's more chance for broad economic growth based on this. If it stays outside of public policy norms, it can't grow big, or it will undermine the tax base, it will undermine all sorts of illicit activities, and it will be a destabilizing force. Better to be inside, and then adjust the public policy norms and the laws where appropriate.
Hi, my name's Jill Marie Griesgraber. I'm with the nonprofit New Rules for Global Finance, and I'm going to try and separate Bitcoin from blockchain. And is it then possible to use blockchain to possibly using central banks to send remittances instantaneously at a very low cost internationally? Especially, I'm aware that there are very high transmission costs from, say, Tanzania to Nigeria, but is it possible to use the blockchain technology to have very inexpensive remittance transfers?
The answer is yes. Much of the cost is because you're moving from one ledger to another. Sorry to get sort of down into the accounting, but you're moving from one fiat currency to another fiat currency, which are in essence kept on two different ledger systems called two different commercial banking systems in, did you say Tanzania to Nigeria? So you have two different ledger systems. And over the centuries, a whole process of Nostra accounts and the setting up of the account base to do that. It can be done on blockchain and between two central banks, but the thinking is that you might need some bridge currency between Tanzania and Nigeria, and there's a number of blockchain technologies that do that, that basically, instead of SWIFT, which is just a messaging system, and then the banks have to somehow pre-fund in Nostra accounts. I hope I didn't lose too many people, but this is about the technology of banking, not the technology of blockchain. But to go between Tanzania and Nigeria, you need somebody to bear some counterparty risk that the ledgers both move and are adjusted at the same time. And usually it's a bank that is in both countries. You could use blockchain, but the current thinking is you need a bridge currency in between, and that bridge could be a stable value that's backed by the US dollar or the euro. It could be a currency even like Ripple has an alternative. It's just piloted in May, so it's not yet up in any enterprise-wide level. But that you might need something to basically hop, skip, jump. Tanzania, I don't know the currency in Tanzania, but Tanzanian currency, to skip to Nigeria, you might need something in the middle, which is called a bridge currency on the blockchain.
It could be Bitcoin or Ethereum. I mean, the remittance companies I'm familiar with, and there's a lot of people investing and innovating in this sector, are primarily using those two cryptocurrencies right now to do exactly this. As the bridge.
And they are taking some of the real costs and some of the economic rents from existing banks and Western Union. If you want to add in on that.
Sure. The challenge is still that if you want to use Bitcoin, unless you've been using, or blockchain, unless you already have your value in Bitcoin, you have to transfer whatever you have into something that works on the blockchain and that intermediate, and then move it on that chain, and then move it back into the other fiat currency. So it's actually maybe more promising if more people are using this cryptocurrency and can use it itself rather than transferring. Having each extra step is still going to cost you money in the blockchain space. And that's where you start to interact with real world regulatory systems as well, because often what happens is to get accounts with the banks, you need all sorts of documentation to prove who you are and get around anti-money laundering requirements. But for many people in these poor countries, they don't have the documents, and that makes it really difficult because the banks don't want to touch them. So if they're able to just, say, mine Bitcoin and get that, then they can do it, but then we have a trade-off with the regulatory system. A lot of what makes it easier to use Bitcoin to move is that you don't touch the banks that are so worried about compliance with anti-money laundering and bank secrecy.
I would add long term, I don't think it's in the next 2 or 3 years, blockchain technology has already today an ability to do final settlement on two blockchains, two different blockchains, and do movement on the two ledgers simultaneously, called atomic swaps, not to be confused with swaps like derivatives. But those atomic swaps, which are at a nascent stage now, could be used by two central banks. The U.S. Central Bank, the Federal Reserve, and the European Central Bank could decide you could do final settlement on both ledgers simultaneously using that technology. I don't see it anytime soon, but the technology does facilitate settlement on two different ledgers simultaneously.
Thanks very much. Oh, yeah, please.
Hi, this is David from PIE. I just have a sort of a clarification or simple questions, I guess. So for my understanding, that blockchain is basically sort of based on two components. The first component is the cryptography parts, the privacy parts that secures that the transaction is in a way public, transparent, but also safe. And based on that, based on mutual trust, that you have a decentralized network. And today the sort of topic was on its impact on finance. So I'm wondering, so earlier that Martin has also mentioned that it was the first component of blockchain that sort of increases the efficiency within the financial system. But to what extent can blockchain really sort of bring more decentralized element to a really centralized financial system that we have right now? Is it by creating a separate market that's based on, coin as a financial product, or is it introducing another platform using, blockchain, creating a new platform and creating a new trading rules? I guess I'm just really curious. I'm just wondering what your thoughts on that. Thank you.
Why don't we wrap it into final comments from each of you as we go along?
Final thoughts. I'm going to I will wrap it in. I think that finance, again, is the world of moving value and risk and intermediating it around a network of whether it's 320 million people here or 7 billion people worldwide. and the blockchain technology that Satoshi Nakamoto brought us was a way to do some of that in a decentralized way without central intermediaries. So it's sort of an irony. It's like intermediation without the central intermediary. It's novel. Its real innovation was the consensus protocol. It was using some otherwise available technologies like cryptography, which Martin rightly says has been used a lot in the last 30 to 50 years. And it's used timestamp logs, which I mentioned, that comment about the New York Times. But it's that consensus. Can you have consensus amongst people that are decentralized? To the gentleman's question, was it David? To wrap up, I think that the decentralized transmission of data or computational power between and amongst ledgers will be adopted in two ways. One is if it actually is a lower cost of trust. Because we do have the cost of trust right now in the current financial sector. It's not zero. I mean, we do have to pay for the banks and the bank vaults and the human beings and the technology, the multi-billion dollars of technology that they're spending as well. Might not be electricity, but the financial sector is 7.5% of our economy. And some of that, not all of it, is the cost of trust. So one, to answer David's question, is if this is just a lowering of that cost of trust and competes with that set of cost of trust. And two, I think there are some sectors that have yet to be centralized, that the nature of the economics of it, whether it's medical records, whether it's the Internet of Things, the I don't know, roughly 10 billion things that are connected to the internet today, and within some number of years, 100 billion things. I mean, like your refrigerator, your lights, your car, things like that. And in finance, I think there's already some areas that will tend towards and lend themselves to this as a better technology. But I would beware of anybody that's a Bitcoin or blockchain maximalist. But I would also beware of the ones that are minimalist too. I think that this should not be counted out as we said in this report, as a catalyst for change, either to spur incumbents to do things differently or new disruptors to get involved, or as Carolyn said, maybe it's big tech who then takes this, and this is the way big tech gets into big finance.
Thanks. Martin, you...
Yes. Yes, so I think if you consider the blockchain as the base layer in a similar way as the protocols that underlie the internet, those could potentially be continued to be decentralized for a long time, but that the applications that are built on them is the way that people and organizations will end up interacting with the blockchain. In the same way you interact with an internet company, you don't interact with a protocol. Most people will not be sophisticated enough to deal in that way. And as things develop, I believe we'll see decentralized applications competing with centralized applications, and each one making it better. The fact that you have competing models, I think, is always good in pushing innovation forward. But and eventually, what is likely to occur is the financial institutions will adopt more and more of some of these decentralized functions into their own. But currently, there are a lot of issues getting in the way. One of them is legal. I was reading about a bank that wanted to do a pilot on Ethereum, but they were unable to get clarity on regulators whether they could buy the tiny amount of ether that would be necessary to actually propose a transaction to the Ethereum blockchain that would allow them to do it. There's very little risk. We're talking tiny amounts of money, but they were not able to get clarity from regulators on that. So it'll be completely separate until we can get more clarity on those issues. But I'm hesitant to say that these decentralized models will be terribly competitive in the short term, partially because of what I've seen in researching financial technology. If you would have asked the economists and experts a few years ago if they thought that peer-to-peer lending was going to be the next big thing, a lot of them, some of the most famous in the world, have said, yes, absolutely. And what has happened instead is that it turns out that the innovations in data that they had trumpeted as being their competitive advantage weren't actually true. Didn't even take a downturn to show that the model was extremely fragile, and that all this data that said that they were going to out FICO turned out to be absolutely incorrect. And it's a good thing it stayed small, because otherwise we would have had a lot more risk. And so I think it's much harder to disrupt the financial system than people think.
Thanks very much, Simon.
So at the beginning, Gary pointed out that the internet, which has changed our lives profoundly, doesn't have a central authority. And I think that's absolutely undeniable. At the same time, we have some very large companies that have done extremely well out of the internet and now have positions that, some people feel more or less comfortable with, where Amazon or Facebook or other companies are. And I think the answer is the technology is changing very fast. Technology-oriented companies will do well. I mean, banks are not particularly good at technology, as far as I can see. The interesting question is, will it be the big tech players who do well out of the internet who figure out how to add on this finance payments layer, or credit layer, or, which is this, actually what's happened in China, I think, or is this space likely to be really taken over by more startups or companies coming from a different space, like running exchanges, right? Coming into retail finance. I think that's to be determined. But the technology is going to change massively, and companies and people who are very focused on designing, running better technology will win big. In the end, how much of the world ends up on a blockchain, I have no idea. Maybe not that much, but this is no question. In the history books, this is part of what has pushed us in the direction that we're certainly going to head now.
Okay, well, thank you very much. Thanks to each of you on the panel, and thanks to all of you and for your questions. Well, yeah, good.